Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Darrell Thomas, and today we have the pleasure of interviewing the rebel capitalist himself, George Gammon. How you doing?
Doing extremely well. Thanks for having me on.
You know, is being a rebel capitalist, is that a lonely road to travel sometimes?
Yeah, it is. But now with social media and channels and programs like yours and conferences, it's not that lonely. I don't think so. I think, in fact, now, especially after we'll call it the cerveza sickness, really opened up people's eyes and gave them the red pill as to what the government, the politicians, and the central planners are really about. And their, let's call it agenda. I think more and more people are rebel capitalists now than ever before.
Yeah, for sure. I've been reading a lot more of Ludwig von Mises and such, and just really understanding more of the Austrian economics as well as capitalism, because that's how I align, and such. And so I think government causes a lot of problems.
It does.
Yeah, for sure. So speaking of problems, the U.S. economy, recently the GDP numbers came out. They were revised downwards. Some people are saying we're in a recession. Others are saying, Trump administration says the economy is booming. And so I'm trying to figure out which one is true.
Well, I think you have to look at the labor market and then GDP. So I don't know that you could even debate the fact that the labor market is definitely in a recession. And so then you have to ask yourself, okay, how do we have this discrepancy between the two? Because prior to that 1.4 print that you're referring to, we had an upward revision from 4.3, which is good, to 4.4. So you had this bifurcation between the labor market, the obvious deterioration in the labor market, just looking at the revisions and the negative non-farm payrolls that we had throughout 2025, the ADP numbers, et cetera. And then you had this 4.4 number that was just in fuego, baby, right? Yeah. we're jamming. We're running on all 8 cylinders. And I kept saying on my channel that one of them's got to give, because you cannot have a deteriorating labor market and real GDP skyrocketing at the same time. At some point that either the GDP has to come down to meet the labor market, or the labor market needs to really heat up to meet GDP. And my base case is that GDP would come down, and that's what we've seen. Now, we'll have to see how it plays out in the upcoming quarters, but my base case is that you'll continue to see a deterioration in the labor market, and you'll continue to see that reflected more so in real GDP than it has in the past. Now, I think kind of one of maybe a contrarian view for your audience is I believe that inflation will do the exact same thing. Mm-hmm. And so I'm not calling for deflation, but I would definitely be in the camp of disinflation, meaning that I understand that the CPI understates inflation, but we'll just use that as a proxy. That the CPI or the PCE, whatever you want to use, that will likely come down over 2026 as opposed to re-accelerating higher. And the reason I say that is because if you look at the U.S. economy, you can go back decades if you want. In fact, I encourage people to do so. And even go back in the 1970s, having a deterioration in the labor market as defined by a huge spike in unemployment, let's say, when you have a contraction in GDP called a recession, you do not have accelerating consumer price inflation in those environments. It's not a thing. People like to think that in the 1970s, the inflation rate just went straight up, along with the recession that we had in 74, 75, and then going into the early 1980s, but it didn't. It absolutely, unequivocally did not. If you just look at a chart of the CPI back then, you'll see that although it was still high, I'm not saying it wasn't high, but when you had that big spike of unemployment in the first recession, we'll call it the 74, 75, you see disinflation. You see inflation running at maybe 10, 11, something like that, and then it going all the way down over the course of the next 2 years to, I don't have the chart in front of me, but maybe 6, 5, something like that. Mm-hmm. And then you see it reaccelerate. And then once you get to the recession going into the early 1980s, once again, you see the big spike in unemployment that typically accompanies a recession. And then you have disinflation again. And that disinflation lasted, call it 40 years. My point there is that if you believe the economy is going to slow to the point where unemployment will actually spike, call it to 5.5, 6, 7% potentially, you have to be in the disinflation camp. You can't be in the inflation. Now, let me be clear. I'm talking about an acceleration of consumer prices, not just prices staying high or continuing to go up slightly quarter on quarter. I'm talking about the CPI, again, using that as a proxy, going from 2.4 to 4 to 6 to 8 to 9 to 10, and that's what a lot of people are predicting, along with a deterioration in the economy and a deterioration in the labor market. And as far as I can tell from the data, and you can go back way prior to the 1970s, it's just not a thing. It's just not a thing. So you got to choose. Are you either on the side of the economy heating up and inflation accelerating, or are you on the side of an economic contraction, deterioration, labor market, and disinflation? And I'd definitely be in the latter.
Gotcha. Okay, so there's more of a inflation isn't necessarily going away, but it's decelerating, so it's not increasing, and that's your point with the labor market recession and things of that nature, and looking at historical charts. How do you factor? Go ahead.
Say we're at 2.4 right now, and I understand that understates it, but we'll just use that as a proxy, a CPI. I would bet that the CPI will actually be lower at the end of 2026 than it is today.
Okay, gotcha. How do you factor in M2 money supply into that equation? Like, what role does that play when they print more dollars and the dollar loses value in that way?
Well, I'm glad you used M2 as a metric, because so many people like to use base money, and people get caught up in this money multiplier idea because that's what they're taught in textbooks, and it's fiction. It's not the way it works in the real world. And so what happens is the Fed creates base money. We all know that, whether it's bank reserves or currency in circulation. And the idea there is that if they create, let's just say, $1 of bank reserves, then the banks now have additional lending capacity. And then they'll go ahead and lend, let's say, $9 or $10 into the real economy, and that will create an additional $9, $10 of M2 money supply. But it all stems from that base money. That's not the way it works, because the banks don't need base money to create loans. They don't need base money for interbank lending. And the proof that I always point to is prior to QE, there were basically no bank reserves in the system. If you look at the Fed's data, it shows about 40 billion. That actually includes vault cash. Most people don't know that. So if you strip out the vault cash, because obviously they're not using that for interbank settlement, and you just look at the electronic reserves that they had, which would be the idea behind the money multiplier, it was only about 10 billion. And now let's think about that for a moment, because M2 money supply back in, call it 2007 or so, was right around 7.5 trillion. But that was domestic. Well, let's think about the overall global economy, because remember, dollars back then were 1/2 of, let's say, 75% of global trade transactions, what I'm referring to. So if there was, let's say the global economy was 40 trillion as far as GDP, I can assure you 30 trillion of that was denominated in dollars. So you figure, even if we have a velocity of 1, just to keep it simple, there would have been $30 trillion that existed, let's just say in 2007, with only $10 billion of electronic reserves used for settlement. So again, effectively, there were no reserves. Banks could have used them if they wanted to, obviously, but they really weren't using them to create more dollars, which, by the way, what is a dollar at the end of the day? Is it a green piece of paper? Yeah, it is. It is. But for most people, a dollar, and 90 whatever 5% of the dollars that exist in the world are simply commercial bank deposit liabilities. They're not green pieces of paper. They're not bank reserves. They're just, as you pointed out, M2 money supply, broad money. And the banks create that. The banks create that by lending it into existence. So getting back to your previous question, I think what most people have to ask themselves is, if you believe the Fed is going to increase M2 money supply, I would ask you how? Like mechanically, how? Because if you don't know how that works mechanically, then you're going to come to inaccurate conclusions on the probability of the Fed actually increasing it to begin with. So let me show you what I'm referring to. So if the Fed does open market operations, which is how they do QE, right? That's how they buy the treasuries to create the bank reserves, quote unquote, money printing. Will that impact M2? Because at the end of the day, like I said, I'm glad you brought that up, because that's what we should be focusing on, because that's how many currency units are actually chasing goods and services. In other words, that's the measurement of what's really going to drive consumer price inflation, that in velocity, and then supply chain, right, or supply side. So if the Fed does open market operations, which they do, they don't choose who they buy from. They don't say, oh, we're going to buy those treasuries from JP Morgan, and then we're going to buy those treasuries from Darrell, who's selling. They don't choose. It's just whoever's selling. So let's think about that. If Darrell is selling his treasuries in the open market and the Fed just happens to buy them, he's trading, let's say, $1,000 worth of his treasuries for what? $1,000. So now his bank account is going to have an additional $1,000 that he didn't have before. Now his balance sheet doesn't really change, because the asset side of his balance sheet still has the $1,000, but now he's replaced the treasuries on the asset side of the balance sheet with M2 money supply. So the money supply has actually increased, you see? But that's if the Fed is buying from a seller via open market operations that's a non-bank entity, Darrell. Let's just say if JP Morgan is selling, and then all of a sudden the Fed buys that, then what happens to M2 money supply? Nothing. Nothing. Because it only impacts the liability side of the Fed's balance sheet, because that's the asset side of JP Morgan, where your asset side, as far as your bank account, is a liability of a commercial bank, therefore it is M2. You see? So if the Fed, as an example, is not buying, and they don't get to choose, remember, so it really depends on who's selling, right? If the big banks are selling, then it's not going to impact M2. If Darrell is selling non-bank entities, then it is going to impact M2. So that's the first bit of nuance there that you got to think about. You can't just look at the Fed's balance sheet and say, oh my gosh, it's gone from 4 trillion up to 7 trillion, and therefore there's an additional $3 trillion of currency units chasing goods and services, therefore consumer price inflation. You see? So then the second thing that you have to ask yourself is, let's just assume that the Fed does 3 trillion of QE, and every single person or entity that's selling is Darrell, meaning a non-bank entity. Therefore, M2 money supply goes up by $3 trillion. But now you have to ask yourself, okay, what are the banks doing? Because remember, the banks are the ones that lent 95% of the currency units into existence. Those are the commercial bank deposit liabilities that we were talking about earlier. So my point is, if the Fed is doing QE as a result of the economy slowing, what are the banks most likely going to be doing? They're going to be lending less, right? Because the amount of risk is going up. Well, if they're lending less and there's more loans being paid off, what's happening to M2 money supply, all else being equal? It's shrinking. It's shrinking. So what you could have there, and what you typically do have, is when the Fed is actually adding to the M2 money supply via QE and the non-bank entities selling, you usually have the commercial banks contracting their lending, which is reducing the M2 money supply by the amount the Fed is increasing the money supply. Therefore, on net balance, it's a wash. So people have to look at that as though it's a bucket of water. And when people think about the Fed doing QE, all they see is the Fed with a garden hose adding water into the bucket. What they don't see is the fact that they're doing that when the economy is slowing down, and therefore there's water leaking out the bottom. And there's big holes at the bottom of that bucket because the banks, the commercial banks themselves, like I said earlier, were the ones that created 95% of the broad money by lending it into existence. So if there's more loans being paid off than are being created, you've got a contraction of the overall money supply globally.
Okay. Man, I should have took a 5-hour energy getting on here with you, George. I'm like, dang. He came with the facts, all those whiteboard videos, man. You dove into the mechanics.
Circa 2020, we pivoted the entire company, turned on its head, brought in new management, George B., our CEO, who's built gold mines all over the planet, and we focused in on CK, copper cake. It was not reliant on drill holes and discoveries. We can go through this process, engineering, permitting, get towards a development stage asset. US Gold Corp is a near-term, low-cost gold producer in Wyoming. To learn more, go to usgoldcorp.com.
When we think about China selling treasuries, how does this factor into the equation? Because we do see like central banks buying gold, selling treasuries, at least China. So how does that factor into this whole picture?
So it definitely matters for the price of gold. It's an absolute nothing burger for the price of treasuries or the interest rates. We'll just look at the other side of that. So why? It's actually quite simple. So if you look at a chart of nominal GDP in the United States, and again, go back 75 years, and you look at a chart of the 10-year Treasury yield, you will see that there's like an 85% correlation. And the 10-year Treasury chart kind of looks like a smoothed out version of the nominal GDP chart. So what we can conclude is in the past, and we can say this definitively, in the past, the 10-year Treasury yield or the long end of the curve has been all about growth and inflation expectations. What it has never been about is debt and deficits. Or it's never been about central banks selling or foreigners dumping treasuries, if you will. So why is it? Because I say that all the time, and initially, if someone hasn't heard that before, it doesn't make any sense. You're like, well, it's supply and demand, George. If the central banks are selling, then that means there's more supply, or less demand, especially if Scott Bessent and the government is running up these big deficits, which we all know they'll continue to do, right? Yeah. And therefore, you have more supply of treasuries, you have less demand. Well, the price can only do one thing. Go down, yields go up. Okay. But now we have to go back and understand that it's always traded on growth and inflation expectations and ask ourselves why. And when you think it through, again, it's not rocket science. So let's just assume for a moment you thought, like, let me ask you a question, Darrell. What do you think the actual CPI is right now in the United States? So if I had, by how much do you think prices are actually going up in the U.S. if you had to venture a guess?
I would say maybe 4.5%, 5%.
Okay. Yeah, so I think that's reasonable. Definitely over CPI, but reasonable. Let's just say 5%. So let's assume for a moment that China started dumping all of these treasuries and Scott Bessent at the same time issued a massive amount. Again, he's got to roll over, $10 trillion this year? Yep. So he's got to issue, and let's say he does this, $3 trillion at one go or whatever. So this causes the interest rate, we'll just use the 10-year Treasury as a proxy. Well, this causes it to go up to whatever, let's just say 10, 12%. And these aren't actual numbers. I'm just using them for the sake of the example. And I'm taking it to an extreme so we can kind of get our head around it. So if you, Darrell, think that the actual CPI is right around 5%, and now all of a sudden a U.S. Treasury is paying you 12%. 12%. What are you going to do?
I'm gonna get Treasuries.
You're most likely going to buy them. Now, maybe not with all your portfolio,
Yeah,
because you want gold, you want silver, maybe some Bitcoins, some stocks, maybe cash, something like that. But for a percentage of your portfolio, especially if you're an older person, you're going to buy Treasuries.
Yeah.
Now, that's just retail. That's the Darrells, the non-bank entities. Now let's think about the banks, okay? Because the banks aren't taking their own money to buy assets. They're taking your money to buy assets, or they're creating money out of thin air by lending to each other to buy assets. So all they're worried about is the spread between their funding costs, or the liability side of the balance sheet, and the asset side. That's all they're worried about. So if, let's say, the 10-year Treasury was trading right around, let's just say 5%, right? And then because that's the market was saying, okay, based on growth and inflation expectations, I'm willing to take, let's just say CPI is at 3%, I'm willing to take a 2% real yield. Real interest rates at 2%, that's acceptable. That's a good risk reward, the banks are saying, based on my other option, which is just lending into the real economy. So if they liked it with a 2% delta right there, do you think they're going to like it at a 7% delta?
Yeah, they're gonna love it.
Of course they are. Of course, the banks are going to be all over that, and as well as retail, the Darrells, and non-bank entities. So what's going to happen? Then if the interest rate spikes for whatever reason up to 10, 12%, you're going to get all this buying. It's going to bring it right back down to growth and inflation expectations, where it typically is. Now, if you go to that bank, and let's remember here, because this is something people have to understand. The bank in aggregate total, the Eurodollar system outside the United States, inside the United States, they have an infinite balance sheet. Their balance sheet is not constrained, okay? So if they are just loving life at a 3% spread between, let's just say, the CPI and what they can get in Treasuries, and now it goes up to a 5 or 7% spread, they're going to be absolutely loving that. Because one of the main reasons is because they're not using their own money to buy those Treasuries. They're paying, let's just say 2% to their depositors, the liability side of their balance sheet, or they borrow the money at, let's say, 2%, 3%, whatever it is, to buy that Treasury at 10%. So does that bank care about the CPI in the United States? Let's just say it goes up to 10%. Do they care? No, because they're simply pocketing a spread. And Darrell, if you could borrow at 2% and buy at 10%, and you could do that as much as you wanted, you had an infinite balance sheet, how much would you buy? The answer is every single Treasury I possibly could get my hands on. Every Treasury. And if Scott Bessent issued another $3 trillion, I'd buy the $3 trillion. Because you're just pocketing that delta, right? And so does it matter what the CPI is? No, it doesn't matter to you, because if you own $1 trillion worth of Treasuries and you're pocketing a 2% spread, what do you care? That's such an astronomical number that your purchasing power is going to be massive at the end of the year, or go up massively, I should say. So then you have to say, okay, well, what about issuance? What if he issues more? Darrell, do you care? No, because you're pocketing the 10%. Who cares what he issues? Mm-hmm. You see? So then the only argument has to become, well, what if the issuance, the deficits, let's say, or debt, what if that leads to inflation, and then that inflation increases interest rates? Well, then you have to show me a chart of the CPI in the United States and show me a chart of interest rates. And what you'll see there, Darrell, is you'll actually see an inverse correlation, whether it's interest rates or a chart of the debt and deficits and the CPI. So if you look at debt and deficits and measure it as a percentage of GDP, and then you look at the CPI, again, you see almost an inverse correlation. So the higher the debt goes, the higher the deficits go. Quite often, the lower inflation goes. It's the Japanification of a specific economy. So that's what people have to recognize is the reason why, by the way, the central banks have been selling Treasuries on net since like 2015. Mm-hmm. So why doesn't it impact Treasury yields? Because once those yields go up to a certain point, the risk reward becomes very attractive for banks, commercial banks, with infinite balance sheets, and they'll come up and make up for that loss of demand. So demand stays the same. That's why a lot of people on social media right now, or maybe for the last 2 or 3 years, have been noting that a lot of the demand has been coming from the Cayman Islands. And they'll say, oh, well, all this demand for Treasury is coming from the Cayman Islands, and that's hot money. And therefore, as soon as those hedge funds sell, then all of a sudden the interest rates are going to blow out, right? We're going to have yield curve control and yada, yada, yada. But what they don't understand is that there's a reason, and I don't think they're hedge funds, I think they're banks, they're buying those treasuries that the Chinese central bank is selling, because the risk reward makes a hell of a lot of sense when their only other option is to lend into the real economy. So that's the dynamic, that's the mechanics at play, that if you have demand go down over here, and that does increase the interest rate to where the risk reward is more attractive, then you're going to have demand increase over here. And that's why when you look at a 75-year chart of nominal GDP and the 10-year Treasury, it tracks with an 80 or 85% correlation.
Okay, gotcha. So what does this mean for the government's interest expense? So that's been kind of a topic. I mean, if we look at, like, I think it's 1.2 trillion or something interest expense. So how does that play into this equation? And just curious in your thoughts there.
Yeah, so think about the question, because what we have to do is we have to really understand our starting point. Mm-hmm. If what I'm saying is true, and that interest rates at the long end of the curve especially are determined by growth and inflation expectations, then that means that debt and deficits don't matter. So if debt and deficits don't matter, then the interest expense doesn't matter. The only way that interest expense can matter, when I'm just talking about in terms of the yield, right? The only way that interest expense can matter is if debt and deficits actually do impact interest rates. And they don't. If anything, they have an inverse relationship. So I always say that the interest, it's another nothing burger. It just, take it to 3 trillion, 4 trillion. Unfortunately, it doesn't matter because the banks have an infinite balance sheet. If that risk reward makes sense, if the yields do go up above and beyond growth and inflation, then they're going to pick up the slack. Now, let me be very, very clear. Because when I say this, a lot of people think that I'm saying that there's just a free lunch. They say, well, George, if we can just create all these treasuries, then why don't we just create a quadrillion and then we'll all be rich? Or something like that, right? Because all these banks will just buy $1 quadrillion worth of treasuries. And it's not that I'm saying the government spending doesn't matter. I'm saying, or it's not that I'm saying that the debt doesn't matter. I'm saying that the debt does matter, but it matters in terms of the government spending. It does not matter in terms of the impact that it has on yields in the Treasury market. You see, and those are two that distinction is very, very important, right? So what I am saying is that there is no free lunch. There is absolutely no free lunch, because if the government continues to spend and expend and spend at an accelerated rate, the price that we have to pay is not going to be the bond market blowing up. The price that we have to pay is going to be the distortions that government spending creates to the real economy. And that's going to be felt by a lower standard of living for Americans across the board, unless you could look at the K-shaped economy. But 90% of Americans, that's going to lead to a lower standard of living. So it's not that government spending isn't without cost. It definitely is, and that cost is disproportionately shouldered by the poor and the middle class. It's just the cost. Everyone thinks that the cost is going to be paid in the Treasury market, and it's not.
Mm-hmm. Okay, gotcha. Okay, so on the topic of In the Fed, shout out to Ron Paul, In the Fed book. Be sure to read that if you all have not read it yet. the Federal Reserve, Kevin Warsh is coming in. There's been a lot of talk about that. Apparently, Trump wants lower interest rates and things of that nature. Do you see the Fed changing at any point? I mean, it doesn't seem like an independent entity. And so just curious in your thoughts on the Fed.
In terms of the Fed setting the overnight rate, do I think that matters? Not really. Not really. Does it really matter if the overnight rate of interbank lending is 3.5 versus 3.25? Let's just pretend right now that the Fed funds, again, just interbank lending. That's it. Overnight interbank lending, by the way, was just 50 basis points lower. Ask yourself, how would that impact the real economy? How would that impact the labor market? How would that do? It really doesn't do much. And I would argue also that the Fed really just follows the market. People think that the Fed lowering interest rates is stimulus and all these things. But what they have to realize is that interest rates overall usually are, over long periods of time especially, don't control the economy. They're simply a reflection of the economy. It's like Milton Friedman said in the 1970s. The lower interest rates usually imply there is tight money, not loose money. And higher interest rates imply that there is loose money. You see? So all my real estate friends, they always say, oh, well, we're going to get bailed out by the Fed. They're going to lower interest rates. I would say, be careful what you wish for. Because those lower interest rates imply that the economy is deteriorating, right? So sure, you might be able to roll over your debt at a lower rate, but for the real estate guys, your occupancy rate is going to be higher because most likely the unemployment rate is going to be higher. And so that's what you got to be careful with those interest rates. But again, that's at the front end. And so let's go back to the last time that the Fed really cut in their cycle, September 2024, going into 2025, they cut by 100 basis points. And what did the long end of the curve do? It went up by 100 basis points.
Yeah.
So and why? Because growth and inflation expectations increased. So the Fed only controls just the front end of the curve. And I would argue they just follow the economy and what's happening. It's not like they control it. And so where they really matter, though, and why I wear this end the Fed hat is their bailing out. When we do run into a cerveza sickness or a GFC or whatever it is, them coming in and bailing out the system and not allowing free market capitalism to work causes just an endless array of problems. In fact, I would argue most of the problems that we have right now in the financial economy, the bubbles and everything else out there, let's talk about Blue Owl, right? Private credit. I would argue all of that is a result of the Fed, but not due to artificially low interest rates or QE or something like that. It's due to the fact that there's always a Fed put. That these guys in the financial institutions know that I would normally take this much risk, but now I'm going to take this much risk. Why? Because if I blow up, who cares? The Fed's just going to bail me out. And the bigger I get, the higher the probability that the Fed bails me out. So why would I take this balance sheet capacity as an example and lend into the real economy when there's a chance I don't get paid back? Where I could just take this balance sheet capacity and lend into the financial economy and lend to Blue Owl and let them take all the risk, and hopefully the tide stays in. And if the tide does go out and I'm swimming naked, then hey, who cares? The Fed, I got a 50-50 chance of the Fed bailing me out. You see? So we've created this perverse incentive structure that creates all of this risk taking and all of these bubbles. And that's not a result of QE. It's not a result of artificially low interest rates. It's a result of the bailouts themselves. So that's why I wear the Fed hat. So my view is we should have free market capitalism where we actually allow people to fail. Going back to Milton Friedman, he always said in free market capitalism, you have a profit and loss system. And what we fail to realize is the loss component is just as important if not more important, than the profit component. And if you eliminate that loss, then what you do is you just have an economy that gets more and more and more sluggish, that gets more and more sick, that just, it's Japanification. Because what you're doing right there, you got to think about it in terms of like, the savannah and how the animal, we'll call it the animal kingdom or whatever, Mother Nature works. If you have the sick lion in the back of the herd, they're out, right? They're done. So they're not able to reproduce. So as an example, or excuse me, so as a result, the herd or the lions as a breed in general gets stronger and stronger and stronger because you're weeding out all of the sickly ones or the ones that with a limp or something like that. That's free market capitalism. So when you have a GFC and you let the businesses that made bad decisions, you let them go bust, what you're doing is you're weeding out all of the people that shouldn't have capital to begin with. And then the resources and the assets go to the prudent individuals, the strong lions, and therefore the herd becomes more and more powerful and more resilient, I think was probably the best word, moving forward. And so what we're doing is we're just propping up all the sick lions instead of allowing them just to go by the wayside and let society society at large reap the benefits. But you got to go through some pain. And that's what the Fed doesn't allow us to do. And that's the big problem.
Yeah. Yeah. I mean, yeah, the banks got bigger and too big to fail and such. And yeah, it's a mess. So I'm curious in your perspective on the whole tariff fiasco that's going on. Is this a nothing burger, or do you see any issues with this tariff revenue or whatnot?
For the S&P 500, I think it's going to shrug it off. I mean, it's down today, 800, 900 points. I don't see it really overwhelming the passive bid. And I think that's why the S&P always goes higher regardless of what's happening with the economy. But as far as the real economy, I don't think it's good because you got to ask yourself, if you're a widget maker and you're trying to bring manufacturing back to the United States, if you've got let's say, I'm not going to say an unfair advantage, but if Trump gives you an advantage by putting in this tariff in place to make it worse for your competitors offshore, that's great. That's fine for you. But still, you've got to invest, let's say, $5 billion to create a factory where you're not going to get the first widget for 5 years or 3 years, let's say, something like that. So are you going to take your $5 billion and going ahead and invest that in where you won't get $1 of revenue for 3 years? Are you going to do that right now? The answer is most likely not. Why? Because you don't know what the hell it's going to look like in 3 days, let alone 3 years. So the problem, I don't like tariffs to begin with, but especially the way they were implemented, it's in a way that I hate to use the word uncertainty because it's so mainstream media, but we can use the word turbulence. It creates so much economic turbulence that you freeze and you don't do anything because you don't know what the hell the world's going to look like. And you're not going to allocate $5 billion worth of capital. You're going to do the very bare minimum until we see how things play out. And so with the Supreme Court decision, they got rid of the one type of tariff, but now Trump comes out and says, okay, it's going to be 10%. And then 2 hours later, or whatever it is, he changes his mind. Well, it's going to be 15%. And who knows what the hell it's going to be tomorrow. And the type of tariffs that he's using only last 150 days, and then it goes back to Congress, which is where it should be in the first place because it's a tax. And so then what happens there? I don't know. Nobody knows. And you look at our trading partners, you look at the politicians, the central planners in these other countries, and I mean, if you were one of them, would you negotiate with Trump now? No, because he lost all of his leverage. What's he going to do? He had this big, huge stick that he just went around beating everyone to a pulp, until they did what he asked. And now that stick may have been taken away. So my point there is, in this type of environment, it's very, very unlikely that businesses are going to put a lot of capital to work and create more widgets and employ more people. Now, a lot of people push back and say, well, you've got all these commitments. You have Saudi Arabia committing $1.2 trillion and Japan, look, that's all talk. It's all talk. Put yourself in the position of being the king of Saudi Arabia or whatever, and Trump comes in. He's like, hey, I really want you guys to do an X, Y, and Z. Are you going to tell him to pound sand? Trump? No, because you never know what he's going to do. The next day he's going to invade you and take you to New York like you did Maduro. Who knows what the hell the guy's going to do? So you're going to sit there and just tell him what he wants to hear. And you're going to say, oh, Trump, no, that's a fantastic idea. Yes. The only reason I wasn't investing in the United States already is because that stupid Biden. What an idiot that guy was. But now that you got him out of there, and now that there's someone just incredible like yourself, the best president in U.S. history, well, now how much do you want me to spend? Well, I'd like you to spend $500 billion. Well, screw that. Let's make it $1 trillion. Done deal. And it's all just words. And you can commit to 45 quadrillion. Who cares? It's just sure. Yeah, that sounds great. When rubber meets the road, it's more than their GDP. So it's not even possible that they can do that, even if they wanted to. It's all just, I hate to, we'll keep it kid friendly. It's all just BS. It's all just BS and brown nosing. And it's not going to materialize unless we can get something, we can get an environment in the United States that is predictable. Mm-hmm. And Trump has a very hard time with that. Yeah.
I'm curious in your thoughts on China. So the whole issue with the rare earths and China, pretty much brought Trump to his knees and such, like with this rare earth situation. And they put in a year-long truce. And then part of this battle was with the tariffs, and they were slapping on 100% tariffs and 120% tariffs, and it was back and forth. The markets were just getting whiplashed everywhere. And then now the Supreme Court decision, ruled against the tariffs, and I'm kind of wondering, what China's thinking over there.
I know what I'd be thinking, that Trump has no leverage.
Yeah.
So whatever we agreed on, we got to come back to the table here, and the terms are going to be much, much different. Now, you could say that in and of itself is a bad thing, but I would say you got to look at these tariffs on net balance, and it's a matter of trade-offs, right? Thomas Sowell always teaches us that there are no solutions, there are only trade-offs. So you've got to do a cost-benefit analysis on tariffs in aggregate total, not just the specific tariff with China. And let's remember, it's not like China has a monopoly on rare earths. They're everywhere, for heaven's sakes. The only thing they have a monopoly on is the processing of the rare earths and the willingness to dig them out of the ground. Mm-hmm. In the United States, we don't have the willingness to dig them out of the ground. And you could point to the EPA. You've got all these people there that, what did they call it? NIMBY, not in my backyard.
Yeah, NIMBY.
They don't want all that gross, ooh, that's bad for the environment. Ooh, yucky. We don't want that, creating all this toxic sludge, and where we're going to put the barrels, and, all the waste, and who's going to do that, and get all the radiation and the liability from, people being exposed or whatever the hell it causes, right? I don't know if you've ever been to a gold mine, but I live in Medellin, and I'd never been to a gold mine before. And I went to, they've got some, I don't know what you call them, but it's very small mines that just come to mom and pop, that aren't owned by big corporations or publicly traded companies. Mm-hmm. And they've got them about 3 hours from here, and they're just on the side of the mountain, the like shanty towns, and they literally just have a guy go in this little hole, and he brings out a wheelbarrow full of rocks, and they just kind of take it across the little dirt road and dump it in the grinder, and that's how they get it. Wow. Doug Casey calls it a choo-choo train business, and it's not even a choo-choo train business. It's like a donkey. It's like a donkey and hard hat.
They got a low all-in sustaining cost over there, huh?
Yeah, but what happened is I'm driving up the mountainside and I'm looking at like the streams and everything. Dude, it is no bueno. I mean it's like it produces like this gray like sludge that was just oozing like out of the mountain. I mean, I'm no lefty or environmentalist or anything, but it was disgusting, man. You could not pay me enough to like wade through that little creek or anything. I mean, you'd start glowing once you came out the other side of it.
Yeah, yeah.
And so this is I don't know, with rare earths, I think they're probably just as bad, if not worse, than the gold mining itself. So that's the bottom line is, do we have rare earths in the United States? Sure we do, but we're just not willing to dig them out of the ground. And therefore we've got to go through all these theatrics and kabuki theater with China.
Yeah, for sure. So just last point, just interested in your thoughts on gold and what do you think for the yellow metal moving forward?
Well, I always have 10% of the portfolio in gold, whether I'm bullish or bearish or whatever, just because I always see it as an insurance policy. And you don't have that counterparty risk. And in today's day and age, I mean, my goodness gracious, we got counterparty risk going through the roof, which is why the central banks are buying it. So you've got to ask yourself, what drove the price to where it is today? Say it's at 5,200. I think the vast majority of that was central bank buying. So, and I think why were they doing it? Because of counterparty risk, because they really pumped it up when Russia invaded Ukraine. We all know the story there. Mm-hmm. So you got to ask yourself the question, are they going to stop buying gold? Is counterparty risk going to decrease at a geopolitical level?
Yeah,
I think the odds of that are extremely, extremely low. Very, very, very low. And so now you've had some retail participation. It really got ahead of itself there the other day, especially with silver coming down and whatnot. But my base case is that the central banks continue to buy, if not more so, in the future, and that's going to put in a constant bid there for gold, and you're likely going to get some more retail participation. And so I don't know what it's going to do over the next 3 months. I have no idea. And if we get a recession, especially if you have a credit event, it's most likely that gold goes down, just like we saw during the GFC. But outside of that, but that's usually a buying opportunity, by the way. Mm-hmm. And if you fast forward 5 years, if you ask me if gold is higher or lower, I mean, I'd bet a lot of money that it's higher. Now, in nominal terms.
Yeah.
In real terms, who knows?
Yeah, definitely. Well, thanks, George, for coming on the show and everything. Where do you want to plug the audience? Where should they go connect with you and watch some of your content and such?
Yeah, you can just go on YouTube. You can type in my name, George Gammon, Gammon.
How many channels you got now? You got like 3?
Yeah, 3 main ones. I just got George Gammon, which are the whiteboards, Rebel Capitalist, which are the live streams, and Rebel Capitalist interviews, where I actually interview people just like you're doing with me right now.
Okay, gotcha. Well, you all got that information. Be sure to go check out George at those channels. Thank you for coming on the show. I appreciate your insights today, and hopefully have you back sometime, man.
For sure. Thanks for having me on.